Welcome to the Prosperity Health GP series. As accountants and financial advisors who specialise in the medical industry, we understand that our clients are often time poor and aren't always able to get into the office during our normal business hours. For this reason, we have released a short series of videos called our GP Health series, which will be available on our website, and this will hopefully be answering some of the more frequent questions we get from our GPs and also help them take control of their personal wealth and their practice. In this video, we'll be looking at protecting my income. Rod, as a specialist in risk advice, what's been your experience with protection strategies for Australians?
Yes, thanks, Brendan, for having me here. And it's quite interesting that Australians will pay thousands of dollars on their car insurance, home and contents insurance, and private health insurance, but often they don't have adequate protection for their number one asset.
Like that, do you mean the home and contents insurance?
Well, yes, that is very important. However, your ability to earn an income is your number one asset. And the reason being is if you're unable to earn an income, you're not going to be able to pay your bills, including your mortgages. And if you can't pay your mortgage, then that asset is gone and no longer your number one asset. So it's very important to have a strategy in place in that event.
What types of protection is available and why do we need this?
Yep, income protection is very important, as we alluded to. It protects 75% of your income. It's paid as a monthly benefit once you've served out a waiting period. And the benefit period can last anywhere between 2 years all the way up to age 70. There's also life insurance, which it protects you in the event of a death. What you do need to consider are things like what your debt levels are, if you've got children, what their education needs are in the future. Do you want to send them to college? Do you want to have a deposit for their first home? Also, what the household income needs is. If you're out of the picture, you want your family to continue at the same standard of living, so you might want to factor that into it. There's also TPD insurance, which stands for Total and Permanent Disablement. And what that means is if you're unable to work ever again, you'll get paid a lump sum benefit. And the needs that you consider are pretty similar to life insurance, which are the debt, education, income needs. And on top of that, likely a carer, because will your family look after you full time? Will your friends look after you full time? We're not sure. And finally, there's trauma insurance, which will protect you for things such as cancers, heart attacks, and strokes. There's about 40 other defined medical events. But what's clear is generally you'll go back to work, but in the interim, you have medical bills that will build up. You have the loss of income that's there too that you might want to replace. And you might want to consider paying off some debt as well.
So protecting the income is the main aim of this, but are any of these tax deductible?
Well, unfortunately, trauma insurance itself is not tax deductible, but income protection is tax deductible. Life and TPD, when held inside super, can be tax deductible, but we suggest to speak with your accountant or advisor to get some recommendations.
So this, I guess this series is specifically for GPs and part of this is around practice owners as well. Is there anything that a practice owner or a GP should be looking at?
Yes, absolutely. There's 3 strategies to consider. The first is called a BuySell Agreement. And how that works is if you're in a business and you have multiple partners in the business and one of the business owners passes away or suffers a serious illness and they're not returning back to work, what will happen is an insurance payout will be received. The business will use that to buy out the person that has passed away or suffered a serious injury or illness, should I say. Now, consider the alternative without a buy-sell agreement in place. The spouse will generally receive the business if the estate planning is in order. When I say receive the business, the sharing business. And that spouse may not actually care about the business too much except for collecting the pay at the end of the day. So a buy-sell agreement ensures that that share is taken care of and the remaining business owners are in a stronger and better position for choice going forward.
That's going to help a lot of people, obviously, from point of view of you don't necessarily want to be in business with the spouse of your partner. You want it to be in business with your partner, and the spouse may obviously know nothing about the business. But what about other staff in the business? Can you do anything about that?
Yep, absolutely. The second strategy is called Keyman Insurance. And what that does is it protects, as the name suggests, key people in the business. So if you have somebody that is a big contributor to generating revenue, say 20%, 30% or whatnot, and that person is out of the picture due to a serious illness or a death, potentially you're going to lose that income pretty much straight away. So in that event, Keyman Insurance ensures that an amount is injected into the business to stem the loss of revenue.
So that's from a people side of thing. What about other expenses within the business? I'm assuming there's some insurance there as well?
Yep, absolutely. There's business expense cover as well. You can think of it kind of like income protection for your business. So if you're unable to work, expenses will continue to pile up. You've got that rent for the premises, medical expenses that you might be hiring out, salaries and so forth. So that will, the business expense will continue to be paid as a monthly benefit to ensure that those expenses continue to be paid until you return back to work.
Thanks very much, Rod. I assume this is obviously general advice and not specific, and if you are after some specific advice, you should talk to your advisor, your accountant, and they can help you on the right track there. I hope you've enjoyed this episode of Prosperity Health's GP series. Obviously, thank you, Rut, for coming in today. If you'd like more information on this, please go to our website, which is prosperityhealth.com.au, and there you can find links to other videos in this series, or also information on how to contact one of our advisors in your area. Thank you.